I think the main problem at the Bank of England, and many commentators, they can't see the wood for the trees. So they tend to look at inflation and focus on whichever individual prices are going up or down the most. The bigger picture, as anybody who sort of studied monetary economics all those decades ago will remember, is that inflation is primarily a monetary phenomenon. And what we've had over the last few years is a massive increase in the amount of money and credit in the economy as a result of interest rates being very low and all the money printing done by the Bank of England. We do need somebody who's willing to go in there and sort of fundamentally reform the way that we deliver public services, the NHS in particular.
The British economy outperformed expectations last year. Inflation came down much faster than most analysts were expecting, particularly, of course, the Bank of England. Economic growth was expected to be negative, dropping by 1%, and in fact it looks like it will have grown by around 0.5%, meaning the UK will have avoided a recession. And employment also remains relatively high. Yet the outlook does not look entirely positive for the UK economy, with continued low growth, structural weaknesses, and global risks. Welcome back to the IEA Podcast. My name is Matthew Lesh, and I'm the IEA's Director of Public Policy and Communications. Each week, this podcast asks a tantalising policy question. Today's question is, what are the UK's economic prospects in 2024? I'm excited, of course, to be joined by the IEA's own Julian Jessop. He's our economics fellow, as well as an independent economist and member of the IEA's Shadow Monetary Policy Committee. Welcome back to the podcast.
Thank you, Matt.
So, looking at the macro situation, it looks like the UK has had a relatively successful 12 months and kind of achieved the mythologized soft landing from inflation. That is, inflation has gone down, but we haven't seen a big kind of Phillips curve expected increase in unemployment.
Yeah, I think that's right. I think it's not often that a single set of economic data can be described as a game changer, but I think the latest set of inflation numbers were. So inflation fell to 3.9% in November. And I think it's actually well on track now to reach the Bank of England's 2% target by the second quarter of this year. And that's really significant because the Bank of England wasn't expecting that to happen until right towards the end of 2025. So it looks like inflation is going to be back on target a full year or more earlier than the bank had expected. And that sort of unleashes all sorts of good news for the economy. And first of all, of course, it means that the squeeze on real incomes will be less than it would otherwise have been. It will also allow the Bank of England to cut interest rates sooner than people have been expecting. Even if the bank's rhetoric on that is still quite tough, the markets have started to price this in already. Those lower interest rates are good news for the government as well. So that increases the fiscal headroom for the Chancellor. So he expects some more tax cuts in the March budget. And overall, high inflation has been the biggest single drag on business and consumer confidence. So businesses and households should be more confident spending this year than they would otherwise have been.
We'll come back to the tax cuts debate in a moment. I think you've actually been quite humble here, of course, because you were one of the relatively, I suppose, few economists who had a more optimistic outlook for inflation over the last 12 months. I was wondering why perhaps you managed to get it right while the Bank of England, with all their, gazillions of economists and fancy economic models, didn't quite seem to get the prediction when it came to inflation correct over the last period.
Well, I think the main problem at the Bank of England, and many commentators, they can't see the wood for the trees. So they tend to look at inflation and focus on whichever individual prices are going up or down the most at the time and say, that inflation is driven by energy prices or it's being dragged down by food prices, whatever it might be. But the bigger picture, as anybody who sort of studied monetary economics all those decades ago will remember, is that inflation is primarily a monetary phenomenon. And what we've had over the last few years is a massive increase in the amount of money and credit in the economy as a result of interest rates being very low and all the money printing done by the Bank of England. So that's what caused the original surge in inflation. More recently, of course, the Bank of England has been raising interest rates and monetary and financial conditions have been a lot tighter. And that's the key reason why inflation has fallen. And also why I think it's likely to keep falling, because money and credit growth is now basically zero. That's either consistent with a very deep recession, or I think more likely, further big falls in inflation and the UK just about skirting recession but only managing weak growth.
So the Shadow Monetary Policy Committee, which the IEA hosts, a group of economists get together and give every couple of months and give a kind of alternative opinion to the Bank of England's Monetary Policy Committee. You've been calling for a cut in interest rates since I think around August this year. Of course, the Bank of England didn't listen to your sage advice to put up interest rates a few more times, although that appears to have ended. I suppose the question now on a lot of people's lips is, will the Bank of England be reversing course sooner than previously forecast? Do you think there'll be a rate cut in the coming months?
Yeah, well, in a sense, actually, it doesn't matter because the markets are doing the Bank of England's job for it. So they've already started to price in big cuts in interest rates over the course of the year. And you're seeing that reflected in, for example, bond markets. So the cost of government borrowing has fallen sharply. The cost of mortgages as well, of course, that could have been a real big threat to the economy. And although many people will be paying much higher mortgages than they would otherwise have been, mortgage rates have basically returned to more normal levels. So that's not a massive headwind for the economy as a whole. You're also seeing a pickup in asset prices. So in the equity market's a bit more comfortable. We seem to have averted a housing market crash. So as long as the Bank of England doesn't wait too long, I don't think it really matters what they do in the meantime. However, at some point, those expectations in the market do need to be validated. Either by the Bank of England actually agreeing and cutting interest rates, or by a continued drip feed of better data on inflation. And as I think we'll actually get both. It might be too soon to expect the bank to move as early as February, but I think by April or May, the bank itself will be cutting rates as well.
Having a look through earlier today some of the expectations from the city economists, as well as some of the broad economic commentary, there's a lot of concerns about, I suppose, downside risks, either inflation being a little bit more sticky than you might expect, or something to do with the kind of geopolitical situation. Obviously, there's a lot of chat at the moment about the impact of the Houthis disrupting trade in the Red Sea. There's been a big uptick in the expected costs of container shipping because they're having to go around Africa. That slows everything down a lot. Is there a potential risk on the other end here where actually inflation is just that little bit more persistent and the economy is a little bit weaker in that respect, and therefore the Bank of England might be hesitant, I suppose, to cut rates?
Well, I think that, of course, there are always risks, but there are actually risks, I think, in both directions. I think that the bigger risk this year is actually going to be deflation. Given the strength of disinflationary pressures coming from money and credit aggregates, I think that's the bigger risk. Particularly also because some of our biggest trading partners, so the Eurozone is already in recession and might drag things down as well. So I think the main risks are actually on the downside. If you look at the upside risks, I think they're actually pretty small. I mean, those of you who want to follow me on Twitter, I do sort of regular charts of this, and I've been looking very closely at the impact of the disruption to supply chains, partly as a result of what's happening in the Red Sea, but also the Panama Canal. Compared to the disruption over the last couple of years, it's frankly nothing. It's just a bit of noise on top. The big risk that might have come from the disruption to the Red Sea is oil prices. If they'd shot up, that would have a quick and immediate effect on prices in the UK, particularly petrol prices. But in fact, oil prices have remained subdued and petrol prices have continued to fall. So I don't frankly see a huge threat there. You're right to mention freight costs, and they have in some cases roughly doubled already this year. But again, compared to the huge increases we saw during the pandemic, that's actually not a lot. And in order for that to have a sustained impact on inflation, those increases in freight costs need to be sustained as well. I don't think they will be. I think that the Western military will get on top of the problems in the Red Sea, and that the container shipping will return to more normal levels. Even if it doesn't, though, again, I've crunched the numbers, as have others. Even what we see now, if it's sustained over the whole year, would only add about 0.5 percentage points to inflation. So given everything else that's going on, that's not going to be a game changer.
And of course, there's other kind of talk in recent days about the relatively cold turn in European weather, which last year might have seen a lot of panic around gas prices, but the gas futures seem pretty stable, kind of indicating that we've sorted out the supply chain issues and there's enough storage, and there's not about to be a big uptick in energy costs as a result of some colder weather. And
also, because going back to the key driver, which is monetary policy, just because some prices might be higher than otherwise doesn't necessarily mean that overall inflation is higher. So in the unlikely event we did end up spending a lot more on energy, then that's less money to be spent on other goods and services. So yes, energy inflation might be a little bit higher, but unless there's the fuel there of an increase in the money supply, then that won't necessarily have a big impact on overall inflation.
So the news is very good, as you've said, on inflation. Now, where, of course, the news isn't so good is when it comes to economic growth. Both in the immediate term, of course, the UK did better last year than expected, but I wouldn't say 0.5% is a great level of growth. And it certainly isn't a great level of growth when we've had relative stagnation for, I suppose, almost 15 years now. It doesn't seem likely to change in the coming year. I think the forecast from the OBR was something like 0.7% growth next year. And what do you think the prospects are on the other side of the ledger? Okay, we've got inflation sorted, but what about actually we're not going backwards in terms of living standards, but actually increasing living standards over the coming year?
Well, I think that's the problem. The question I often get asked is the UK heading for recession? And the usual definition there is 2 successive quarters of negative growth in overall GDP, the overall size of the economy. I think we will avoid that. But if you look at GDP per head, in other words, you adjust for the increase in the size of the population, then we are actually in a recession on that definition, because GDP per head shrunk both in the second and the third quarters of last year. So I think that's the way to look at this. In terms of output per head, we're not doing great at all. And you touched also on the long-term economic problem that we've had very weak productivity growth basically since the global financial crisis of 2008. And one of my favourite, or if you like, least favourite figures there is that if productivity had continued growing at its pre-crisis trend, then output per head would now be something like 25% higher than it actually is. And if you translate that into living standards, then that's a massive hit to the quality of life in this country, because productivity in particular has been so weak.
Yeah, it doesn't seem like there's a bigger economic fact to me as well, that the UK, I suppose, per capita income is something like 40% below the US now. It's not like the US is a little bit richer than the UK. The US is substantially richer than the UK because of that period of stagnation while the US has had all that growth. I'm wondering, how do you turn that ship around? So we've obviously heard so much talk from both parties over the last 12 months about growth. It's certainly something Keir Starmer has highlighted from the opposition, and something Rishi one of his 5 pledges was to get growth going. What is the answer here?
Well, you won't be surprised to hear that economists disagree on this. There's what we call a productivity puzzle, and there are lots of different potential explanations for the puzzle that lead to lots of potentially different solutions. I think if there is a consensus, it's that we need to invest more in this country. Investment, improving the quality of the capital stock, more skills, training, better education and so on, is the key to getting productivity up. There's still a big debate though about who should do that. I mean, some people think it should be the government. I obviously think it should be the private sector as far as possible. So the emphasis should be on creating the conditions in which businesses want to invest, in which people want to set up new businesses and deliver the sort of cutting edge technology and change that we need. And for me, that's mainly about creating that good environment. So that means not just low taxes, but also simple taxes and taxes that are fairly consistent from year to year, that aren't constantly chopping and changing. That's something we've been bad at recently, particularly on business taxes. It means having a sort of regulatory regime that allows people to build. So that's issues like planning reforms and so on. Now, I think a lot of that is sort of almost motherhood and apple pie. People would agree with it, but if you look at individual policies, there's always somebody who can come up with an objection. They don't want a power plant in their constituency, or they don't want a new housing development in their back garden. So there's lots of resistance to those sorts of changes. There's also a perception that companies are a sort of magic money tree, that you can always just shake more money out of companies, whereas in fact that we know corporation tax in particular is one of the worst taxes for damaging the economy and deterring investment and job creation. So a lot of people talk about these things, but in practice it's quite hard to deliver.
Yeah, I think the challenge for politicians is to do those kind of reforms to get the economy going again. It seems like there's also some other structural issues going on in the economy. One that comes to mind is the labour market. So of course, we're in a situation of relatively, strong labour market for those who are in it. But of course, a lot of people have left the labour force since COVID. Yeah. You've got really huge numbers of people claiming disability support payments, as well as kind of other government supports. It seems like there's a huge problem there as well when you then add on top of that over the coming years, you've got an ageing population as well. Yeah. So you're going to have fewer people in the workforce and more claimants on them. It seems there's a big structural squeeze coming on workers, and because there's few of them and the government promises so much and people want so much from the state, it's going to be hard to get out of that slight, I suppose, high tax, high spending, low growth situation that we've found ourselves in.
Yeah, you're right. I mean, productivity is absolutely key. You need to get more out of your existing workforce, but you also need to grow the economy by getting more people back into work. So it's not just about productivity, it's also about participation rates. And there are a number of different things that you need to do there. And as ever, it's partly a mix of carrots and sticks. If you think about some of the people who are not in the labour market who could be, then it's people on disability benefits who would now be able to work, and more should be done to help and encourage them back into work. Also, a lot of older people have retired earlier than they might otherwise have done, perhaps during COVID, and they need to be tempted back into work. One way of doing that is by making sure that the tax regime works for them, so getting rid of some of the ridiculously high marginal tax rates that some potentially higher earners could face. It's also about making sure that the labour market is as flexible as possible. One of my hobby horses here is that some people are campaigning against 0 hours contracts, but actually they're particularly good not only for younger people, students, but also older people who have the option to work or not work, who actually quite like the flexibility of 0 hours contracts. So you need to make sure you have as wide a variety of different employment options as possible to tempt people back into work. And of course also to make sure that work pays through low taxes in particular. So I think that's probably the key thing, is a mix of carrot and sticks to get everybody who wants to work or can work to do so.
To get a little bit more controversial, for a lot of people the issue here is really about immigration. It's that the UK is importing mass numbers of cheap, low productivity workers, and that's why businesses aren't investing properly in boosting productivity and why people aren't coming back into the workforce at the same rates as might be necessary. Do you buy that kind of an argument?
Well, I'm reasonably relaxed about immigration from a sort of free markets economics point of view. I think you should have free trade as far as possible, and that includes bringing people in to fill vacancies and to add to your skill sets. But even I actually recognise that there are constraints on the sheer numbers of people coming in, particularly if many of those people are not actually working. They are the dependents of workers. So I think there are problems there. I wouldn't personally obsess too much about overall numbers, and in particular I wouldn't artificially try and hit targets by doing things that are silly, like for example preventing students from coming here from overseas. One of our biggest export successes is education, so it seems odd to close that door. But I do recognise that the sheer numbers are sometimes putting pressure on public services that need to be funded, and that's not always possible.
So you mentioned the UK's tax situation a few times in the discussion already. I think this week begins the national insurance cut, and there's been this big debate about whether or not taxes are actually going up and down, and a bit like Schrodinger's tax changes. You can look at it. It's both alive and dead. They're both going up and down depending on how you look at it. I wonder what you make of that debate and where things are going in terms of the UK's tax burden.
Well, okay, I think I'd characterise it sort of 5 steps back and 1 step forward. So if you look at what's happened over the last few years, the tax burden has increased, and it's actually set to increase further, primarily because of what economists call fiscal drag. So the levels at which you start paying tax have been frozen, even though inflation in terms of prices and wages has been strong. So more people will be paying higher rates of tax. So the tax burden is going to continue to go up. It will go up less than it would otherwise have done, because of the cut in national insurance contributions. So that's an important step in the right direction, if I can put it like that. But I think a lot more needs to be done. But as I said earlier, because of the lower inflation numbers, the Chancellor will have a bit more room. And it wouldn't surprise me at all if he decides to cut income tax in the next budget too.
Yeah, it seems this is becoming almost politically toxic for the Tories, of the recognition of them as the high tax party. The Labour Party's got a calculator now about how much less tax you would be paying if income tax thresholds went up with inflation. It seems like the little bonus for government from high inflation is the fact that the fiscal drag pushes up everyone's taxes. I wonder what you think, though, the priority should be for tax cuts, or perhaps even if the priority should be tax cuts, should there be more concern about the national debt, which is approaching 100% of GDP, rather than all these kind of tax cuts that are now being talked about by everyone?
Okay, well, I mean, starting with the debt numbers, I'm sort of actually fairly relaxed about that. I don't think it really matters whether the debt is 100% of GDP or 105 or 95. What matters over the longer term is whether it's going up or down. And the best way to get debt down over the longer term as a share of national income is to grow national income. So if somebody can make a decent case for tax cuts or even spending increases that boost the economy, then I wouldn't worry too much about the short-term impact of that on the debt numbers. The question then is, which taxes do you cut, or where do you increase spending? And I think we haven't had a brilliant debate about that over the last few years. I think for me, the most important thing about tax cuts is that they need to improve the performance of the economy in some way. Putting more money back in people's pockets is important, but there are other things at the moment that are bigger priorities, and I would suggest that's anything that might boost productivity. Now, you can do both. For example, if you put money back into people's pockets and therefore encourage them to go back into work, or you put money into the hands of companies that then use that to invest, then that can not only boost the demand side of the economy, but also the supply side of the economy as well. But it's important to get that mix right. It isn't just about giving money back, even though I think that's important. You want to try and do so in some way that improves the underlying performance of the economy as well.
The other one there, of course, which doesn't get enough attention, is something like stamp duty, is a particularly inefficient tax that discourages housing transactions and creates a kind of delirious economic impact. A big deadweight loss, I suppose, might be the economic term for it.
Yes, so stamp duty is a good example of a tax that almost all economists hate, because it's basically a tax on transactions. It's actually a tax on economic activity. And it's completely bonkers that the amount of tax you might pay on a house over its lifetime will depend on how many times that house changes hands, rather than any other key driver of what the economic value of that house is. So economically, it's a daft tax, and I'd love to get rid of it. I wouldn't necessarily make it my priority. I wouldn't, by the way, make scrapping inheritance tax my priority either, but I might put them in a manifesto as something that I'll be looking to get rid of in the next Parliament.
And of course, the other side of the ledger here is the spending. So it seems to me that we've had a lot of promises for tax cuts, but the reason why taxes are so high and they remain so high is because we've got record levels of spending on things like healthcare, for example, in the NHS, which has had a huge boost in spending and not particularly much increase in productivity. There's a lot more need to be done on that side of the ledger in order to get down taxes and reduce the size of the state.
Well, again, we need a much better debate here. It's often said, do you want tax cuts or do you want increases in public spending? With the implication that if you have tax cuts, it has to be at the cost of public spending. I think it's far more nuanced than that. Tax cuts that boost the economy will create more revenues in the future than you would otherwise have. It's also possible to reduce the size of the state without, for example, cutting individual benefits if you get more people back into work. And the NHS is actually a superb example also of the broader problem of productivity. So this is a problem across the whole public sector. Private sector productivity growth has been poor since the global financial crisis, but at least it has grown. Whereas on some measures, the public sector is actually now less productive than it was 10 or 15 years ago. So lots more money has been pumped into the NHS in particular. There are more doctors and more nurses, but they're actually often treating fewer people than they were before the pandemic. So there is a big productivity problem in the public sector. I think there's lots of reasons for that. There's another podcast potentially in that. But I think the key point is that there's been a lack of investment, a lack of adoption of new technologies and so on, which I think could have the potential to fundamentally transform the way we deliver public services. And the Chancellor, Jeremy Hunt, for his credit, is on this. Actually, funny enough, so is Tony Blair, the former Prime Minister, thinks a lot about this as well. But we do need somebody who's willing to go in there and sort of fundamentally reform the way that we deliver public services, in the NHS in particular.
Is that, though, something that's, in my mind, a bit aspirational in the sense that politicians will also always often talk about technological solutions, and undoubtedly they could be some improvement that could come to public sector productivity by adopting AI in healthcare. But it seems like you need kind of more fundamental institutional reform to change the incentives within the system so that the technology is used successfully and productively. You actually need things like competition and markets within the public sector as much as possible.
No, I absolutely agree with that. If you look at some of the services that are provided by the private sector in the market economy, you have seen big increases in productivity in those sectors. And I think fundamentally that's because of competition. So people are competing in areas like recruitment consultancy, for example. So that service has become much more efficient than it was before. But that's not happening in the NHS because there's no competition.
Yeah, it seemed to me, West Reading went to Singapore recently and had a look at the healthcare system and came back with what I thought was almost like a shallow analysis. He said they have a really great computer system and they have much better technology than us, and I think that's undoubtedly true.
Yeah.
But it seems to me that's almost like it's almost like a symptom of a structurally better healthcare system that involves competition and patient choice and different demands on it, rather than something necessarily as an end in itself, as if we could just adopt the Singapore's IT system and everything would be grand.
Yeah, I mean, there are lots of things that are fundamentally wrong with the NHS, and one thing people often say is that only if we had a better government that would pour more money in. Sort of begs the question, why have you got a model for such an important public service that depends on the right party being in power? I mean, there's fundamental problems with that as a model. So yes, I think the NHS needs root and branch reform. It needs more competition. It does need more private sector involvement, whether that's through financing or provision of services. That's not inconsistent with universal healthcare, free at the point of use. It's about how you fund and deliver those services. But if we look at the more successful models, as you say, in Asia, but also in the rest of Europe, they have much higher levels of private sector involvement and competition than we do in the NHS.
Well, of course, we have poured loads of money in the NHS, and we haven't necessarily, as you've said, productivity's probably gone backwards.
I mean, if you look at our spending as a share of GDP for the NHS, it's towards the top of the table.
Well, we could, I'm sure, go on about this all day long, and we'll save some of public sector reform thoughts for a future podcast. It's been an absolutely fascinating look at the year ahead for the UK economy. Some good news and some bad news as well. Julian Jessop, who is the IEA's Economics Fellow. If you are enjoying this podcast, please do subscribe in your chosen podcast provider. And if you'd like to learn more about the IEA and follow our work, just visit iea.org.uk.